Hey everybody, it's Daniel here from InfoVest. Hope you're all doing well. So there's this Bloomberg article here, comes out basically 3 days back, and you might have seen it. But if not, it's basically titled "Car Owners Fall Behind on Payments at High Rate on Record," highest rate on record. Basically talking about auto delinquencies on the rise. People's cars are being repossessed because they're unable to make payments on their cars. Now, I'll put this link in the description so you could read up on it. But basically, the article starts off saying Americans are falling behind on their auto loans at the highest rate in nearly 3 decades. With interest rate hikes making newer loans more expensive, millions of car owners are struggling to afford their payments. It's a clear indication of distress at a time when the economy is sending mixed signals, particularly about the health of consumer spending. Right now, in terms of the data, when you look at the economic data, it has yet to show weakness. But if you do look at many companies who are coming out with their earnings report, or some of the tech companies out there, you're starting to see, even forget about tech, even the banking industry and other places out there, you're starting to see layoffs start to accumulate and accumulate, and people are losing their jobs as companies are tightening. Right, so there are indications out there, and just like in the previous video, I also discussed about two big Wall Street traders out there, hedge fund traders, right, talking about that they see risks of recession, risk of things in the economy that could end up being worse than expected. Expecting, for example, Bill Gross seeing a recession in the fourth quarter of this year. Bill Ackman basically covering his short position on bonds, saying that there's risk again into the economy that could bring a bid into safe haven assets like bonds and so on. So you're seeing all of the news start to puzzle in together. The only thing is, right, it happens slowly until the big moment where things really break. What is that moment? We will find out when it comes. Now, going more into this article here, it says the percent of subprime auto borrowers at least 60 days past due on their loans rose to 6.11% in September. That 6.11% in September is the highest in data going all the way back to 1994, according to Fitch ratings. In April, that figure slipped a bit to previous high of 5.93% in January, but it ticked up. And that's the thing, right? You will see signs that, oh, look, the economy is getting better, delinquencies slightly coming down. Are we going to a recession? Are we not? Remember the whole soft landing narrative everyone's talking about, right? People were massively short last year. If you look at the equity markets, they basically, especially NASDAQ, rallied most of the sell-off. And if you look at the commitment of traders report in NASDAQ, you could probably you could see that people are basically threw in the towel of shorting equities. So now you can argue that, okay, it's time to see weakness in the equity market, especially with tech and NASDAQ, if there is supposed to be a hard landing or credit event, right? And again, as the number ticks up from 5.9% in January to now 6.11%, you can expect this number to even creep up further as layoffs continue and as, more deterioration in the economy. Especially if you see that come soon with some sort of, again, event, right? It's going to all be coming down to an event that spur things and cascades into worse off rates, worse off delinquency rates, and so forth. Now, in the article, it says behind the surge in both higher car prices and borrowing costs, and with the Federal Reserve indicating its plans to keep rates higher for longer, the problem is likely to persist, especially as millions of Americans recently started paying their federal student loans again. Right? So basically it's saying that, hey, car prices, like you might have seen, are high up there. And with borrowing costs staying high up because, rates are staying higher for longer. They're not coming down, especially if you think that, the economy is doing fine, that's a good thing. Well, not necessarily, because that means rates are going to stay higher for longer. So, that's going to bring more pain to individuals who are paying not only for the car loans, but also their student loans and any other loans that they may have. If it's only if when that event comes, credit event, etc., that you expect the Federal Reserve to then come cut rates, and then you can get easing in these borrowing costs. Now, going down into this article, it talks about a few individuals. For example, this 27-year-old college student in Maryland basically, found out one morning that she woke up and didn't see her car there because of payment issues, right? So basically, the car being repossessed. So you're seeing that affordability crunch in the markets. You're seeing it start to creep up, even though there's dips. Same thing, you look at the housing market and whatnot. You might see spike in the prices and like, oh, look, it rebounded. That's the bottom there, so we're not going to go lower. That's not true. That's not true. That's not how the economy works, right? Although the stock market is a leading indicator you could look at, but also there's a lot of things about the markets that traders often get wrong also. So don't think that they're right all the time, and there's much more involved that makes it more complex to understand what's happening. So what we can do is look at how this data is coming out and look at history, how that has suggested previously, when we see such rates, such delinquency levels, when we see such tightening in the markets, when we look at the past 2 years of over leveraged consumers, over leveraged investors, eventually as rates go up and they stay higher, and if those bond yields go up, right, especially on the long end, it's going to create some sort of panic, some sort of issue in the economy that could cascade into bigger problems, could cascade into those job losses, could cascade into, again, those delinquency levels moving up, could cascade into much more problems for the rest of the world. Now, heading into the end of this article, it says repossession uptake. It says as payment delinquency rise, repossessions are expected to increase accordingly, according to Cox Automotive. They estimate 1.5 million vehicles will be seized this year, which is basically up from 1.2 million last year. So although that's still pretty below pre-pandemic levels, that's still a higher number, and that number can definitely change as the economy changes as well. It also talks about, and again, another person here, 31-year-old bartender, saying that having difficulty with their auto payments, talking about, needing money from their parents also to help with the payments. And as the economy takes a hit, she's a bartender, she says she feels it. She says she makes $2 an hour on live tips, right? On tips that she gets. And when things get more expensive, people have less money, and they're basically coming to the restaurant less, and they're tipping less, and there goes the wages, there goes the dependency on those tips, right? A lot of these waiters do depend on that tip to help them get through. And if you're having those high food prices, grocery prices, restaurants and whatnot, people, you're going to expect less people to come in. And especially if there's job losses, guess what? You're not going out to eat and enjoy as much as you were during the growth era of the cycle, right? The economic cycle. So very interesting article. Again, I'll link it in the description for you to read up on it. And it basically shows you the signs that things are not as good as what people may be thinking. There's much more to expect. Economy is taking its time because there's the economy, it's taking much longer than expected because you have other areas, like for example fiscal side of things, that like spending and so on, that is keeping the economy afloat for now, right? And when you look at the car market also, new vehicles and used vehicles, the prices are still up there. They have downticked a bit, right? But And the main issue comes around with the supply of things, especially with chips and shortages, which are having problems, which the car market is affected by. But if those delinquencies rise and they continue to rise, right, it would be interesting to see if there's more supply that ends up coming into the market, more inventory, which I expect, right? You could expect more car inventory to show up if we do get into a scenario of a hard landing. Because if that hard landing happens, right, this is an article right now that you're seeing in times where we're not really at the peak of the recession, of the hard landing, right? Things are still looking okay. But if you were to play this out in the peak of the recession, peak of the hard landing, you can expect more companies to come out and basically lay off more workers. And if that happens, it trickles into people. What's the first thing you're going to do? You got these car payments, get rid of it, right? You need to eat, that's more important. You need shelter, that's more important. So, okay, I don't have a job, I don't need to go to a job, I don't need a car to go to a job. Okay, get rid of it. And that's where you can see those auto delinquencies and repossessions come in. And if that inventory goes up, then you can expect that should alleviate some of the car prices to come down. So if you're shopping for a car, maybe you might see prices might get better in a year or two from now, right? And it's all depending on how much supply ends up coming from these repossessions. Right? So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.